Hey guys, welcome back to our channel. Today we're going to talk about a very interesting topic, investing in property or the share market. Both are great ways to invest your money and build your wealth, but which one is the better option for you? In this video, we'll be discussing 10 points that will help you make an informed decision. Point 1. Initial investment. The first point to consider when deciding between investing in property or the share market is the initial investment required. Property investment requires a significant amount of money to get started, as you need to buy a property, pay stamp duty, legal fees, and other associated costs. On the other hand, the share market allows you to start with a smaller amount of money. You can start with as little as a few $100s and gradually build your portfolio over time. When it comes to investing in property, you need to have a substantial amount of money to get started. You'll need to save up for a down payment, which typically ranges from 10% to 20% of the property's value, depending on your lender and other factors. Additionally, you'll need to cover other costs like stamp duty, legal fees, inspection fees, and other associated costs. All of these expenses can add up quickly, making property investment a significant financial commitment. On the other hand, the share market allows you to start investing with a much smaller amount of money. You can start with as little as a few $100s and gradually build your portfolio over time. This makes the share market more accessible to a wider range of investors, including those with limited financial resources. Point 2. Liquidity. Liquidity is another important factor to consider. Property is a relatively illiquid investment, meaning it can take a long time to sell your property if you need to access your money quickly. In contrast, the share market is highly liquid, and you can easily buy and sell shares as and when you need to. Liquidity refers to how easily and quickly you can convert your investment into cash. Property investment is a relatively illiquid investment, meaning it can take a long time to sell your property if you need to access your money quickly. This is especially true if the property market is experiencing a downturn or if you have a unique property that may take longer to find a buyer. On the other hand, the share market is highly liquid, and you can easily buy and sell shares as and when you need to. This makes it a more flexible investment option, allowing you to easily adjust your portfolio based on your needs and goals. Point 3. Diversification. Diversification is key to reducing risk in your investment portfolio. With property investment, you're putting all your eggs in one basket, which can be risky if the property market takes a downturn. In contrast, the share market allows you to diversify your investments across different companies and industries, reducing your overall risk. Diversification is an important risk management strategy that involves spreading your investments across different asset classes, industries, and geographical regions. With property investment, you're putting all your eggs in one basket, which can be risky if the property market takes a downturn. In contrast, the share market allows you to diversify your investments across different companies and industries, reducing your overall risk. This means that even if one company or industry experiences a downturn, your overall portfolio will not be as severely impacted. Point 4. Income generation. Investing in property can provide a steady income stream through rental income. However, you'll need to consider expenses like maintenance costs and vacancy periods when calculating your potential income. The share market can also generate income through dividends, but the income is not as predictable as rental income. In contrast, the share market can also generate income through dividends. Dividends are payments made by companies to their shareholders, typically on a regular basis. However, the income generated from dividends is not as predictable as rental income and can be affected by factors like company performance, economic conditions, and changes in dividend policies. Point 5. Capital growth. Capital growth refers to the increase in the value of your investment over time. Property investment can provide strong capital growth over the long term, but it's not guaranteed. The share market can also provide capital growth, but it's subject to market fluctuations and can be more volatile. In contrast, the share market can also provide capital growth, but it's subject to market fluctuations and can be more volatile. Share prices can be affected by factors like company performance, economic conditions, and investor sentiment. However, With a well-diversified portfolio and a long-term investment strategy, the share market can provide strong capital growth opportunities. Point 6. Taxation. Taxation is an important consideration when investing in property or the share market. Property investors can claim deductions for expenses like mortgage interest, rates, and repairs, but they also need to pay capital gains tax when they sell the property. Share market investors also need to consider taxation, but they can benefit from franking credits and other tax advantages. Both property and share market investment have tax implications that you'll need to consider. With property investment, you may be eligible for tax deductions on expenses like interest payments, maintenance costs, and property management fees. Additionally, capital gains tax may apply when you sell your property, depending on the length of time you've owned it and other factors. Similarly, with share market investment, you may be eligible for tax deductions on expenses like brokerage fees and investment advice fees. Additionally, capital gains tax may apply when you sell your shares, depending on the length of time you've held them and other factors. Point 7. Time commitment. Investing in property can be time-consuming, especially if you're managing the property yourself. You'll need to deal with tenants, maintenance issues, and other property-related tasks. In contrast, investing in the share market requires less time commitment, as you can buy and sell shares with just a few clicks. Property investment requires ongoing maintenance and management, which can be time-consuming and costly. You'll need to maintain the property's condition to keep it attractive to tenants and ensure that it's compliant with legal requirements. Additionally, you'll need to manage tenant relationships, including handling rent payments, repairs, and tenant turnover. All of these tasks can add up, requiring a significant investment of time and money. In contrast, share market investment doesn't require ongoing maintenance or management. You can simply buy and sell shares as and when you need to, without worrying about ongoing upkeep. Point 8. Emotional factors. Investment decisions can be influenced by emotional factors like fear, greed, and overconfidence. When investing in property, you may be emotionally attached to the property, which can cloud your judgment and lead to poor investment decisions. Additionally, property investment can be a stressful and emotional process, especially if you're managing tenants or dealing with maintenance issues. In contrast, share market investment can be less emotional, as you're not emotionally attached to the shares you own. Additionally, share market investment can be less stressful, as you can easily buy and sell shares as and when you need to. Point 9. Leverage. Leverage refers to borrowing money to invest. Property investment allows for higher levels of leverage, as you can borrow against the value of the property. However, this also increases the risk associated with property investment. In contrast, leverage in the share market is generally lower, as many brokers have strict requirements on margin loans. Point 10. Your personal preferences. Ultimately, the decision to invest in property or the share market comes down to your personal preferences. Consider your financial goals, risk tolerance, and time horizon when making your decision. If you enjoy hands-on investment and are willing to put in the time and effort required for property investment, it may be the right choice for you. If you prefer a more passive approach and want to invest in a diversified portfolio, the share market may be the better option. In conclusion, so there you have it, 10 points to consider when deciding between investing in property or the share market. As with any investment, it's important to do your research and consult with a financial advisor before making a decision. Remember, there's no one-size-fits-all approach to investing, and what works for one person may not work for another. Thanks for watching, guys. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to our channel for more informative content.